When we get to Bitcoin, the narrow measure has been the better measure with a 45-day lead. And, we can try and map it up now. And it would suggest that Bitcoin does okay, but nothing amazing yet until that narrow liquidity starts really rising. So it's what's been holding it back. Now, as I said, these things shift around a bit. So there's nothing is perfect, but contextually, Bitcoin is trading at a discount to where liquidity is. It could play catch up and then continue with this, or it could continue to mirror the pattern and sort of readjust itself at these lower levels. We'll have to wait and see. But over time, Bitcoin should go higher because global liquidity is going higher, US broad liquidity is going higher, and US narrow liquidity should go higher as soon as they can get the yield curve to steepen.
Bitcoin's price isn't random. It's following a hidden pattern that explains 87% of its every move, and almost nobody's talking about it. Raoul Pal, the respected macro investor and Real Vision founder, has spent years tracking this connection. He explains that when you compare total global liquidity with Bitcoin, the relationship is unmistakable. Leads and lags shift over time, sure, but the underlying connection stays remarkably strong. Even accounting for those shifts, Pal says liquidity remains the single biggest driver of Bitcoin's price. Over the long run, global liquidity explains roughly 87% of Bitcoin's price movements, a staggering number for any asset. Here's what makes Bitcoin different. It's historically the most liquidity-sensitive asset in the entire market. Bitcoin and global liquidity have shared 93% of their long-run price movement, the strongest macro relationship of any major asset tested. Pal notes that narrow liquidity measures give the clearest signal, leading Bitcoin's price by about 45 days. Mapping today's data against that pattern, he believes Bitcoin is set up to perform well, with higher prices ahead as liquidity keeps expanding. And that expansion is already happening. By mid-2026, major central banks have pivoted hard. The Fed and ECB have settled into a Bitcoin-friendly easing cycle, real yields are compressing, and global M2 liquidity is climbing again. If this holds, Bitcoin's breakout isn't a fluke, it's a genuine macro tailwind. Before we dive in, welcome to Bitcoin Frontier Hub. We're a growing channel pushing toward 1,000 subscribers, and every single one of you helps us get there.
Here's total liquidity against Bitcoin. Now, you get leads and lags, and they keep moving around a bit. But generally speaking, if I can match these two up, and we can see in recent times, they're highly correlated. We've had them with a 90-day lead and lag. It shifts around over periods of time. Markets are Bayesian as opposed to, strict sets of rules. They shift and the factors change. But liquidity is the dominant driver of Bitcoin and explains over time about 87% of Bitcoin's movements. You can see now that liquidity leads Bitcoin, financial conditions leads liquidity, which leads Bitcoin. So it's giving us an ability to forecast somewhat, not to perfection. Many of you saw the breakdown between global liquidity and Bitcoin, which happened in the last 18 months. It doesn't mean that the everything code is wrong. It's liquidity shifts around in its influence and where it's driven. And a lot of it went into the AI trade. And Bitcoin basically got down to the narrowest measure of liquidity, the pure debasement side that drives it, which is telling us there's less speculation in crypto than there is in AI, less capital is being attracted, but it still is driven by the debasement cycle. When we get to Bitcoin, the narrow measure has been the better measure with a 45-day lead. And, we can try and map it up now. And it would suggest that Bitcoin does okay, but nothing amazing yet until that narrow liquidity starts really rising. So it's what's been holding it back. Now, as I said, these things shift around a bit. So there's nothing is perfect, but contextually, Bitcoin is trading at a discount to where liquidity is. It could play catch up and then continue with this, or it could continue to mirror the pattern and sort of readjust itself at these lower levels. We'll have to wait and see. But over time, Bitcoin should go higher because global liquidity is going higher, US broad liquidity is going higher, and US narrow liquidity should go higher as soon as they can get the yield curve to steepen. So global liquidity increases about 8% a year, which is how much money you are losing on holding non-scarce assets. On your money, you're losing 8%, and you've probably got something like 3% inflation to deal with as well. So you've got an 11% hurdle rate on your investments. If you're not making 11%, you're not actually making money at all. And that's something that's quite difficult to understand. And my work over time has suggested there are only two asset classes that really beat debasement over time. And those are technology and crypto. Crypto I think of as just a technology. And what we've got there is two massive secular trends. And those secular trends, as the world adopts new technologies, massively outperform the debasement. So those things make us wealthy. Things like gold tend to be in line with global liquidity. So they protect our wealth, and that's important too. But most others don't really make us money at all. The S&P 500 barely breaks the 11% hurdle rate. It's really not compounding because it's not fully technology. You see, technology and the output of intelligence is the most important thing in the world right now. And blockchains are a technology, and they work extremely well in this environment, but they're more volatile, as we all know.
Every government on Earth is quietly printing money at the same time, and Bitcoin was built as the escape hatch. Raoul Pal, the respected macro investor and Real Vision founder, lays out exactly what's happening. Global liquidity keeps rising over time, he says. Zoom out on the chart, and it just keeps climbing year after year. This is the ongoing debasement of money. As money is debased, the value of the currency declines. That's why scarce assets like real estate, equities, Bitcoin, crypto, and gold appear to rise in price. In reality, Pal explains, it's often the purchasing power of money that's falling, not the assets rising. This is precisely why Bitcoin is qualified as a hedge. Its monetary policy is completely disconnected from central bank decisions. When money printing accelerates, investors seek out assets with a fixed supply to avoid dilution. Bitcoin plays the role of digital safe haven because it's mathematically impossible to create more of it to absorb debt. Looking ahead, Pal sees continued liquidity growth, a steady increase in money creation to finance debt. And this isn't just a US story. China, Europe, the UK, and many other countries are creating money for the exact same reason, and it affects all asset prices globally. As Pal puts it, as long as global liquidity keeps increasing, the dollar's purchasing power keeps declining. Right now, global liquidity is growing at roughly 8% per year. Let's get back to the video.
But you can see that over time, global liquidity and crypto are basically the same chart. And you get the excesses, and it depends where you draw the line, but you draw it somewhere there. Bitcoin's cheap. In speculative periods, it gets expensive versus global liquidity. And that's how it goes. People expecting a perfect fit. And, maybe it's my mistake by showing times when it does fit perfectly, like the NASDAQ chart does. You now think, oh my God, it's definitely going to go up here and it's definitely going to follow this chart. And then it doesn't, because it doesn't most of the time. But overall, when you step back and you look at it on a monthly basis, what you get is super high correlations. You don't need to do anything. And here is US total liquidity. So this is the US Fed net liquidity. So that's the balance sheet. That is the TGA. That was the reverse repo, which has now been drained entirely. And it's the banking sector and its total loans and leases. And what you find is that exactly mirrors debt to GDP. It's because this is the liquidity that pays for it. We've switched from just the central bank balance sheet, and then it went to Fed net liquidity, and now it's gone to this broader measure. And the broader measure is because they've now reinvigorated the banking system to start lending again. And they need it for the capex boom, but they also need it to fund the government because they can take more risk now. And so they tend to buy more debt. And that was some changes in the ESLR as well. And US liquidity also perfectly matches the interest payments. So we can project it out into the future. So the liquidity is the creation of money because only the central bank and government and the banking system can create money. So this is them creating money to pay the interest. And we can look forwards because it's lagged by 36 months. And all we see is a wall of increasing liquidity or printing of money to pay the debts. Now, the printing of money is very interesting for us because it has other mechanisms. If we go to global liquidity now we understand that liquidity is the important picture here. So this is global liquidity because the Chinese print money and the Europeans print money and the Brits print money and everybody prints money for the same reason. They're all kind of in it together. So what we've got is global liquidity keeps going higher. I can shrink this down. We can see it over a longer period of time on this chart. And it just keeps going and going and going. And that's the debasement of money. It's this that forces the denominator lower, which is the value of money falls, therefore scarce assets, real estate, equities, crypto, gold keep rising. But they're not actually necessarily rising. It's because you're devaluing the denominator, the purchasing power of the dollar, the world's global currency. And this is the picture of that. This is when it happens, is when this keeps going up. And it's going at about 8% a year.
Bitcoin could be entering an important phase as rising liquidity creates a stronger foundation for future growth. While short-term moves may stay uncertain, the bigger picture continues to favor Bitcoin as global money supply expands and currencies lose value over time. Patient investors who focus on long-term trends instead of daily price swings may find the best opportunities ahead. The next chapter for Bitcoin could be closer than many people expect. Do you think Bitcoin will be the biggest winner when global liquidity rises again? Share your thoughts in the comments below. If you enjoyed this video, please like, subscribe, and turn on the notification bell so you never miss the latest Bitcoin news, market insights, and price updates. Thank you for watching, and we'll see you in the next Bitcoin video.